You may have heard that the mortgage market is being supported by the government, but what does that really mean? We will try to bring some clarity to that question in a few short minutes. The word is that the Federal Reserve is lowering interest rates by purchasing mortgage-backed securities. Rates are moving to record lows, and everybody knows this, but how do you take advantage of it? How do you ensure that you get the mortgage that you want? Just because everyone is trying to refinance, should you? If so, when's the best time to act and how? As you can see, here we have a long-term chart showing how much of rates have fallen in reaction to the move the government has made since the middle of 2008. Starting here, rates have reacted to this intervention by falling dramatically. As you can see, once they stopped forcing rates down a couple of weeks back, they started to creep back up. But now they're moving down again. How long can they hold rates down this time? A week? A month? Who knows? Save money by refinancing to a lower rate. Seems simple, right? But there are many ways to save, and the right one for your situation may not be the right one for your neighbor. First, you can save money every month by simply refinancing on the same term you have at a lower rate. Second, you could refinance both to a lower rate and a shorter term, less years, and reduce the amount of payments that you make by thousands. Finally, cash-strapped homeowners can use the one or two skipped monthly payments to rebuild their cash flow and possibly pay off some smaller outstanding bills. All are great options, but often people are asking us in this market, what if rates go lower from here? Fact of the matter, folks, is the credit crunch is out there. If you lose your job, you are no longer eligible to secure new financing or a refinance. If your home drops in value further than it may have already, you may no longer be eligible to refinance. And if you incur some additional debt, you may no longer be eligible to refinance. The fact of the matter is a lot of hardships can take away your ability to get something done. What if your car breaks down and needs to be replaced? What if you have unforeseen home repairs, water heater bursting, air conditioning needing to be replaced, new roofing, etc.? Unforeseen medical expenses also can cause a hardship financially. But most importantly, what if the banks change the rules? Stricter guidelines would mean not allowing you to take cash out of your home where you previously would, forcing you to pay PMI or a host of other little banking tricks that the fat cat bankers continue to roll out there, making it difficult for consumers to get financing. This includes not allowing you to subordinate your existing home equity line of credit or otherwise making it hard to borrow. In essence, lenders that have no stake in your first mortgage transaction making rules because they hold a second mortgage as to whether or not you can refinance. And then, for example, making it harder to borrow, the self-employed struggling to get approved by most lenders no matter how good their credit is. Just in the past week, you see an email here that says the changes to FHA cash out policies were lender and investor based. FHA now states that cash out with loan to value ratios over 85% must have a case number dated before April 1st, 2009. This is an email dated March 16th. And the last day to submit these type of loan programs was March 17th. 1 day notice to the changing rules. Can you act fast enough to get this done? And how do you make the best decision? Here's the big win. With our exclusive software, we can help you make sense of today's market and make a good, solid decision about your refinance. The first thing we're going to do is compare your loan to several options available in today's market by taking your current loan and stacking the monthly payment numbers up against a loan with the same terms, as well as a loan that might have a longer term, so you can understand the monthly payment impact that those decisions are going to have. And then we look at the long-term results. By choosing staying on the same loan, refinancing your balance, refinancing the original amount of your loan, or cutting your mortgage term, you choose which loan works best for you as the customer. You should be able to understand that this customer would save $41,000 by refinancing their balance, but would save over $100,000 by shortening their term. It's this type of empowering decision making that we want to help you have at America's Mortgage Choice. So contact our team here today to get the best understanding of the market, and be able to choose your next mortgage based on the numbers instead of feeling like you've had that loan sold to you. If you'd like more information about a total cost analysis of your mortgage options, email info@amchq.com. Thanks so much.